Oh, here he comes. So let's get over to the Federal Reserve. The interesting thing is what they're going to do is they're going to come out and kind of tell us what they've done.
Good day.
And, just the scripted thing. And
My
then they're
second
going to
FOMC
really
committee
start
meeting
answering some
as
questions.
chairman has come quickly.
Let's get over to the video.
It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission-focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. 2 economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information, and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal, and where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech CapEx has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows 4-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussion centered on 4 questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second, my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases in tariff rates, and yes, the surge in AI-related investment. These differ in their sources. Do they also differ in their effects on output and employment? Third, we took up the related question of price increases arising from shocks. The business CapEx boom, for example, is driving up prices of memory and logic chips and associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Let's start with Steve.
Thank you for taking our questions, Mr. Chairman. Sure. You've had a couple months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me, what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying to do, Steve, as I think you appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message, letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves, what does that mean about our remit? How are we doing on inflation? How are we doing on employment? We're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, why we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman, and I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so
Sorry.
I'm sorry, it's your question. So interpreting markets is an imperfect business. We central bankers, like market pros, can think these things are overdetermined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the treasury market signals, I wouldn't be able to do it perfectly, but the bond market's saying many of those same things, and that's why we're seeing a tightening both in nominals and in reals. Even while at some level we haven't done much in 42 days, the markets have done quite a bit.
Claire Jones, Financial Times. You seem to have got the family fight you were after at this meeting. We saw three dissents.
Okay, so let's get over to what they were talking about. So let's see, let me just summarize what happened. This is what I like when he starts coming in and asking questions, because these are the things we want to know. We came in now and we know what they did for rates. So now what are they thinking? What are they talking behind closed doors? That's what we want to be concerned about. And he hit a lot of these out of the park, because nominal rates, meaning interest rates, we watch the 10-year Treasury and the MBSs that you watch on this channel. They've been going up, up, up. They've been following oil. Well, the Federal Reserve's rate been steady. So they're saying that the rate spread, the markets are taking care of it themselves. So that's pretty good news. So let's see how the markets reacted to this. If you guys got some questions, love to, I got an echo going on. My apologies. Let me see if I can get rid of. Is there still an echo? If you guys can let me know, echo, is there an echo out there? Let me know on that if you can. I'll try to talk a little bit louder to get rid of the echo. We'll get this fixed. I apologize. So let's get over and see what's happening in the markets. So the first thing, like I do with every show, we go to the rates, but I like to go to the chart. So this is a great chart. Still a lot of reverb and yarly, but still understandable. Okay, my apologies. I don't know how to change up that in any means. It's getting a double feed from somewhere, so my apologies. Let me just try to do the best I can. If I speak louder, is it better or softer? So just adjust your audio if you don't mind, because we're getting into the juicy part now. So here's what's happening. The Federal Reserve came in and said, we're not going to do anything. And the cool thing is, it was a 9-3 vote that they were coming in saying, okay, most of us are for not doing anything. We're going to sit on our hands. And I think that was kind of the best decision on a lot of these. So let's go through this, but we're going to go back to here every so often, because I want you guys to hear some of these questions, because this is when the markets really start to move. You can see this. They came in, they kind of did nothing, and then all of a sudden the markets are rallying, and this will continue to move throughout the event. So we're -4 right now. See what the oil market's doing. Oil's up 7%. That's going to just kill the markets. Got the markets down, just getting clobbered. The Dow Jones is down almost 900 points. NASDAQ teetering there. So the Federal Reserve, they look at these things. But let's get back to the Federal Reserve. Let me know. We'll get back to his questions. I'll come in. We'll see if we can fix the audio while we're doing this. But let's get back to some of the questions they have, because what I want you guys to do is kind of what they're asking is what I would ask this person. It's like, okay, what do you think? And what do you things like that, to kind of dive in to try to figure out what he's going to talk about. So let's get over to it and see if
so we'll be watching inflation data over the period ahead. But I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks, but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
Neil.
Hi, Chairman Warsh. Thanks. Neil Irwin with Axios. Thank you for taking our questions. So the Fed funds rate is now about 75 basis points below the 2-year yield. It suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate, inflation stays high. Why should rates not be higher today?
There's a lot in there, Neil. So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make. I'll see if I can put it this way. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. We'll be continuing to watch that market information, see how it responds to incoming events, and that can help inform our decision making when we meet in 7 or 8 weeks.
How would you characterize in the family fight the last couple of days of you and the other 8 members who wanted to hold? Was that a strong conviction, or was that a hair trigger close call on holding versus tightening?
Well, I think the vote was 9-3. The broader discussion to my ear over the course of the last days showed a lot of agreement on the hard questions. The 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely. But my own judgment is this is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Colby.
Thank you. Colby Smith with the New York Times. You've mentioned that looking at the Fed's policy tools is one element of a 3-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days. Is that the dominant remedy if inflation continues to be elevated through the forecast period? Interest rates could well be part of that solution, but I wouldn't say it's in isolation. I tried to describe in my remarks today a point that I made to the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we'd call that the revealed preference. And so might it have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no. We will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, Colby, is performance. We are going to be judged by how we perform. And that's what we intend to do. The inflation target, making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like you referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion in the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. But we're trying to understand is to what extent are these shocks broadening in their effects, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed. I'll be the first to admit the shocks make this job and this policy conjuncture a little tougher, but that's among the chief questions we've asked ourselves. And around the room, people have different views on it. I tend to think in the coming months, we're going to refine that view and have a better judgment, and we're going to have market prices trying to help inform it too.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. I guess I want to drill down maybe a little bit. What specifically, in your mind, would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause. I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big hard questions, and I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermeeting period, they didn't pause, they reacted to the inflation data in one direction, strong economic growth in the other direction, and nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve chairman uses the Jackson Hole Summit as a sort of a reset of monetary policy. Well, how do you look at the speech that you're going to make in August?
I look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you've characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods. But they matter more, what are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, which is I'm checking with those task forces. My first principle of establishing a task force is find the best subject matter experts anywhere in the world and put them together, especially put them together with other people who might disagree with them. In the next couple weeks, I'm going to be doing a check back in. I've given them time to sort of think hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform anything I have to say in Jackson.
Nick Timmeros of the Wall Street Journal. Chairman Warsh, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. Rates bring inflation down by cooling demand. It's generally thought that can show up in the labor market. If that's not the channel you're relying on, what is?
Yeah, so let me go back to first principles, Nick. I don't believe that either part of our mandate is generally at war with the other part. I do not believe that price stability and full employment is an either-or proposition. There have been policymakers over the last several generations who have thought that there is a strict trade-off there. That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable such that employers, businesses, wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools in making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order, but really what we're doing as we sit here today at this press conference is I think we've got a reasonable sense of what aggregate demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business CapEx in around AI, it's making that calculation a little harder to judge, but in the period ahead, we're going to be trying to judge just that.
So we kind of ended at that. That was a lot of the information. Ooh. My apologies. Let me know if you guys can still hear me. Give me a thumbs up or just let me know if there's an echo. I don't know what's wrong with the echo. We will work on getting that removed at some point. But let me just go over what happened today. The Federal Reserve came in and did nothing about it. Okay, I didn't think they would. Here's my thought behind all this. Let me know if you can hear me. Look at it this way. We have an economy that the jobs market's okay. That's been okay for a while. It's low, higher, low, fire. We agree with that. Inflation, it's higher than 2%, and it's been over 2% for 5 years. But lately it's been skyrocketing because, and we can tag this onto oil. So if you can basically say it's oil related, think of it this way. Oil's bringing up the cost of everything. Laugh out loud. It was good, and then you did, and broke it again. It's good. Okay, it was good. I don't know. Sorry about that. So why would inflation is driving up prices, that's aka inflation. And it's because of oil. And we even had a housing report today. Check out some of my blogs I put in today. Housing inflation is running at the lowest level we've seen in about 4, 5, 6 years. That makes up about 30% of the inflation numbers as well. So if you have the housing numbers coming down, I know it's hard to believe, and then you have oil, the energy price, if you take it out of the equation, because eventually that's going to be taken out, why would you increase rates? Things are already way too expensive for us because of energy, and then if you increase interest rates, that's going to increase payments. It's just going to be a mess. So that was my thought behind it. It's not, okay, this is inflation on these other levels. We know it's coming from the energy markets. So let's get over to you, Dave. So if you're new to my channel, you've been on here for a long time. Thanks for staying with us. Here's what we watch each day. This is a mortgage bond that trades on Wall Street. This move of up 7 might not be like much, not seem like much, but let's go down through here. We're at 96.9. So let's say 97. We're at 97.27, so we're up about 30, 35 points. That's a pretty darn good day. So if we didn't have this kind of crash today earlier, this is a good day for the markets when it comes to interest rates. Now, here's what's happening behind the scenes. A lot of people were saying, okay, Dan, oil's up, down, and whatever, but why do rates change all the time? Or, why haven't rates come down yet? So here's my thought on this. I was on the proponent. I didn't really know. I knew the Federal Reserve probably wasn't going to do anything today, but I'm saying this. I'm saying we got to wait for this Iranian situation to get over with, but the longer this goes on, here's my fear. If you have to cap these oil wells, like cap them, shut them down, that's going to be really bad. And if we demolish a lot of them, that's not going to help either. So if you got oil prices continuing to rally, that's going to be bad news for interest rates. That's going to be bad news for you and me on the economics of things. So this is what we're seeing: as oil goes up, think of it this way: oil goes up, makes the cost of everything more expensive. That means that's inflation. So if that goes up, the Federal Reserve monitors that and says, okay, we don't like high inflation. We got to increase rates. Just think of it that way: oil up, inflation up, well, interest rates up. The same thing on the way down. So whenever this war does come to a conclusion, we should be okay. When? I don't know. So that's the problem that we have now. So if you go to this, the market's getting tanked. Let's wait till tomorrow. It could be up another 500-600 points. Here's what's interesting. Federal Reserve, they're watching these things. Okay, so here's what I want to explain to you guys. I'm going to go to a second and show you what the probabilities of or what the Federal Reserve is going to do at the next meeting. But if you look at this data here, we're going to get, PCE, that's the inflation number the Fed looks at. We look at the unemployment rate. Well, let's look at over here, the economic calendar. Well, tomorrow, we got the Federal Reserve news today. Tomorrow, we got GDP, we got the PCE, initial job. We're getting everything that the Federal Reserve really watches. This could hugely move the markets. So it's going to say the PCE. This is core. We're also going to get the numbers without the core. Let me explain this to you. PCE is the inflation number that the Federal Reserve puts the most weight into. Okay? Core, if you see core on the front of anything, that basically means they stripped out the energy piece. Okay, so if you're looking at this, you're saying, okay, the core is stripping out energy. Let's see how that's going, because if you take out energy, let's see how the rest of the inflation's going. Well, they're saying month over month, it was going from 0.3 down to 0.2. I'm okay with that. It's down. Let's look at the PCE year over year, 3.4 to 3.3. It's going down, but it's still not at 2. So this is inflated. We got GDP that's cranking, and he's saying it's probably going to even crank even more because of the AI build out. Then you have initial jobless claims. This is where I'm starting to get a little skittish, because if you look at the trend of the jobs market, it's starting to not look a little bit. So I don't know what's going to go on. So we'll continue to monitor this. This is the exact same stuff the Federal Reserve monitors. So if you're looking at this, you're saying inflation's high, the jobs market's low, higher, low, fire, GDP's good, and you know it's all inflation, I'm sitting and holding tight. So let's see what you guys are thinking about. Let's answer any questions that you guys. Do you think they already know the numbers? I think they do. But they just, what they don't know is, what's down the road. These numbers, they probably know it. At least the Federal Reserve officials, they know this because it's already put together and so forth. So they might know something that we just don't know. I don't mind coming out. I tell my kids the same thing. If you don't know something, just say you don't know. But what I'd like to do is find out my research. That's why, even recently I came up with a video that was, checking my forecasts and how I did. Because when I come in, I want to make sure if you're watching me, I give you the most factual data. If it's good, bad, whatever, but at least it's the most factual data I can provide you. Let's see. The Federal Reserve, what are they supposed to do? 48 days. Now, here's where I was getting at. This could change in a heartbeat. Go over to this. What this is telling us is, there's a 90. I told you there was a 100% chance they weren't going to do anything at this meeting, which if they did, I would have been completely shocked. Okay, until the next meeting, there's now a 75%. Now let's take a snapshot of that. So 75%. Tomorrow, after all this data comes out, my opening bell, check it out. Make sure you subscribe and post over there. So when we come out in tomorrow's video, I'm going to give you these numbers and what the market does. And then we're going to look at seeing how much this moves. Because I'm still saying, now I don't know if this war continues for another month, 2, 3, the Federal Reserve might have to increase rates. I still think it would be the wrong move because we know it's based on energy. But that's just how it works. So we'll see how this goes tomorrow. If you want to check out some of my data, each day at my morning video, I come out and I also post a blog on our website. Go to the website, hit resources, hit blogs. You're going to get all my blogs down through here. I posted actually 2 today. It's going to give you the CPI and all the readings. Fed rate cuts finally coming. No, I was just kind of sarcastic there, and some other things. So each day I post a blog post there to help you understand a little bit more about what is going on with these and why they change on a daily basis. So that's it for today, folks. The MBSs are up 3 ticks, a far cry from their negative, I think, 20 earlier today. So mortgage rates are going in the right direction. Federal Reserve did nothing, and mortgage rates are doing okay, but it's that pesky oil that we got to worry about. So watch oil, follow my channel, You'll understand what's going on with mortgage rates, and the most important thing behind it all is you understand why they change on a daily basis, and then really the information behind it. So thanks for watching. Don't forget to subscribe. Each day I come in to give you guys that information. Last but not least, who am I? What do I do? My name is Dan Frio. I'm the host of the Rate Update. I'm also a licensed mortgage loan officer in all 50 states, as well as Puerto Rico. If you need some help with the mortgage out there, folks, I'd love to help you out. Till next time, peace and be safe out there. Take care. Have a good one.